Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in case you're new to the channel, I feature stock analysis, personal finance, and also company analysis in the stock market as well. And my main mission on the channel is to kind of demystify everything that goes along with value investing and things like that. It's all about kind of a journey with each other to get to financial freedom. So that's really the main focus of the channel, and to try and make things easy as possible to understand as well. So this week I'm going to cover how to read a balance sheet. So let's get on with the video. So the balance sheet is one of the three main financial statements that you will get released in the company filings. The point of view I'm talking from is mainly US stocks, but you'll see this in other companies as well, as it's a very similar model in other countries. So first we have the income statement, which I'd done last week, and now we're going to have go over the balance sheet, and next week do the cash flow statement. So the balance sheet is really about making everything balanced between the company's assets and its liabilities and shareholder equity. That's why it's called the balance sheet. Now, the balance sheet is really just a snapshot at a moment in time of what we own, which is our assets, and what we owe, which is our liabilities. So this will normally, you'll see this reported at the beginning of a period of time and at the end. So then we can kind of compare and see what's changed over that period of time. So we can see here we've got the assets equal the liabilities plus the equity. So similarly with the income statement, with the balance sheet, we start at the top and work our way down. So what we'll see first is all the company's assets. So first we'll have the current assets, and these are the most liquid assets. So this is anything which basically can be turned into cash within a 12-month period. So this is really kind of shown in the order of liquidity. So you'll see this written in the statement as cash and cash equivalents. So this would be actual cash that the company has in the bank, or it would be US government treasury bills and other money market instruments like that. And these are places where the company can put their money to make a better interest than just holding it in a standard business account. The maturity on these would be less than a year. So that's everything that you find within the current assets is assets that you can turn into money within 12 months. And it's good to have a lot of cash on hand because it means the company is able to pay off its short-term debts with its current amount of cash available. And next we move down to accounts receivable, which is money which is owed to us for services that we've already delivered to another company. And then we've got inventory. So this is slightly less liquid because to turn the inventory into cash, obviously we have to sell that. And then there is a section on prepaid expenses. So these are advance payments for goods and services which are to be received in the future. They can't be converted to cash, but since the money's already been spent, it actually frees up capital for other uses. So now moving on to the non-current assets. These are considered long-term assets. So there might be any investments on this if the investment cannot be turned into cash within 12 months. So you'll also see the main assets which belong here are property, plant and equipment. So this will include land which is owned by the company, items of machinery which is required for the company to operate. So this would be kind of machines in factories and things like that. And these are also assets which depreciate over time. And then moving on to the next one, we've got intangible assets. So this is assets which are not physical, but they represent a value to the business. So this could be things like a brand name if you're a company like Coca-Cola, for example, because obviously there's a lot of strength with the brand name. Also patents and trademarks and copyrights would be considered intangible assets as well. Another one of these would be goodwill. Now goodwill is a kind of strange one, but what it actually is if a company acquires another company for a greater price than its net asset value, then the difference between that is considered the goodwill. If I'm like the CEO of a company and the fair price of the company I'm buying is say $50 million, but I buy the company for $100 million, then I've got $50 million of goodwill because maybe I'm paying for the brand or the patents of the other company there. and that is shown as the 50 million on the balance sheet. And then we have other assets, and now this will depend a lot on any particular industry, but it's obviously anything that doesn't fall under the ones I've already mentioned. And once again, these are listed from the most liquid to the least liquid, going down. So now we're moving on to current liabilities. So these are short-term financial obligations which are due within the next 12 months. The current liabilities are usually settled using the current assets. That's what we want to see in any good business. We'll go on to that in a bit more detail a bit later on though, particularly in respect to the current ratio, which is a good measure of the financial health of the business. So in here we've got accounts payable. So this is money that we owe to our suppliers for products and services which we've purchased already. So next we've got accrued expenses, and these are anything that's already been accrued for but hasn't yet been paid. So this could be taxes, interest, wages or bonuses for a certain period for the staff. Then we go on to taxes. So this might be any income taxes owed, payroll taxes or other government taxes, and also short-term debt will be in here. So that's any debt or loan payments where they're due or the interest is due on those within the next 12 months, and also dividend payments to the investors as well. So the important thing to remember with the current assets and the current liabilities is the fact that it's all to do with the next 12 months. Current assets are anything which can be turned to cash within the next 12 months, and the current liabilities are any payments or debts that are due within the next 12 months as well. So now we'll move on to the non-current liabilities, and this would be things like the long-term debt. So this might be any interest on principal amounts which is due more than 12 months in the future. Also bonds payable, deferred tax liabilities. So this would be taxes which have been accrued but will not get paid for another year at least. And then we might have long-term lease obligations. So this could be leases on land or buildings or any other assets where the payment won't be made for at least another year. And there will also be pension benefit obligations. So this is retirement benefits due to any of the employees in the future. And the liabilities will be shown in terms of which payments are due first, going down to which ones are due last. So then after that, we move on to shareholders' equity. So the shareholders' equity is made up from the money initially invested by shareholders and also any subsequent money that's been invested into the company as well. And the second part of this is retained earnings, which are profits which the company is held on to but not paid out to shareholders in the form of a dividend. So this gets carried over from any previous period. And the shareholder equity is actually the company's net worth. For us to calculate the shareholders' equity, we're just removing the total liabilities from the total assets, and what we're left with there is the shareholders' equity. So I'll just jump into a quick example now. So we'll have a look. On the left, we'll see our assets. So we've got current assets, say $500 million, non-current assets of $1 billion. So that gives us total assets of $1.5 billion. And on the other side, we can see that our liabilities, we have 250 million current liabilities, 500 million non-current liabilities, giving us a total of 750 million in total liabilities. And then what we add onto this is the shareholders' equity. So the share capital is worth 700 million and the retained earnings is worth 50 million. So we've got 750 million in shareholders' equity, 750 million in liabilities. So add those together and that adds up to our 1.5 billion. So we can see then our assets balance with our liabilities and the shareholder equity. So we'll go and look at a real life example in a few minutes. I'm going to look at Facebook and Boeing because that will show you two kind of very different companies. So we'll look at the balance sheet for both of those companies. So just before looking at the balance sheet for Facebook, I'm just going to point out a few of the key things that we're looking for when we look into the balance sheet. So we want to see positive working capital, and what this means is that our current assets exceed our current liabilities. This is important because it enables us to cover our short-term liabilities. If this is negative, then this is obviously a bad sign because soon we might run into problems and need to take on debt to cover our short-term obligations. And what we're looking for here is the current ratio. So if we take our current assets and divide it by our current liabilities, then that gives us the current ratio. And what we're looking for in a current ratio is ideally 2 to 1 or more. You'll find a lot of decent businesses, especially established ones, that there will be maybe like around the 1.3, which is still fine because that means they've got more money short term than they've got obligations to pay off, which is still good. But ideally, you can find companies with a 2-to-1 ratio or greater for that. And we also want to see the liabilities going down. We want to see, like, look at last year's liabilities and the year before and see, are the liabilities decreasing? Because that's the ideal scenario. Or if that's not the case, then at least we want to see that the liabilities are not growing at a faster pace than the assets are. We also want to see equity growth year on year. So the equity is what we're left with after we remove the liabilities from the assets. So here we're looking at Facebook's consolidated balance sheet. And we can see here, as we look for the important things, what I mentioned before, we're looking for positive working capital. So we need to look here at our current assets minus our current liabilities. So we can see here Facebook total current assets 75,670, so that's 75 billion. And then we can go down and see the current liabilities, which shows us 14,981. So if we take the 14,981 off the 75,670, then we're left with around 60 billion that Facebook have got in kind of positive working capital. So this is a really good sign, and if we divide those numbers together, then we get the current ratio, which is actually 5.05. So we can see here that Facebook is in a really healthy position from that perspective. And then also we're looking for the total assets to be greater than the total liabilities. So we can see here Facebook's total assets 159 billion there, and their total liabilities 31 billion there. So this is also like a really encouraging sign for Facebook. And we can also check on the comparisons between the 2020 and 2019. So we can see here for the assets grew in total from 133,376 to 159,316. In terms of the liabilities, we've actually seen a slight decline as well in the liabilities. So 2019, 32,322 to 2020, 31,026. So that's like another good sign from their balance sheet. And now we can move on to the stockholder equity. We can see here the total stockholder equity has risen from 101,054 in 2019 to 128,290 in 2020. So that's another one of the signs that we're looking for here as well, that the equity is increasing. And now we'll be able to see the balancing part. So here we've got our total assets, the 159,316. And then down at the bottom, the total liabilities and stockholder equity, 159,316. So that's the part that balances out. So now we'll go and look at a different example from Boeing. So obviously it's been fairly well publicized that they've had a lot of issues previously with the Boeing 737 MAX program, with that being grounded for a couple of years after two major accidents. And also they got hit hard with the pandemic, with obviously airline orders stopping due to the airlines not being able to fly. So they've deferred or cancelled some of the aircraft orders that they had. So this has all hit Boeing quite hard. So again, looking from what we were previously, so going to the total current assets, so we've got 121,642, and let's go down and look at the current liabilities, which is 87,280. So that still gives Boeing 34 billion after you remove the liabilities, current liabilities from the current assets. And if we divide that up, we get a current ratio of 1.4, which is actually decent as well. But one thing we need to be careful of here is, like, if we go and dig a little bit deeper, we can actually see that Boeing have taken on significant long-term debt since the previous year. So 2019, the debt was standing at just under 20 billion. and now they've increased the debt to what is almost now like 62 billion. So what you will see is probably some of that debt has been used in the current assets, because they've got their hands on the cash for that now. So that's probably why the actual current ratio is 1.4, due to some of the amount of the loans being in the current assets. And here's another like sign. So we look for kind of the warning signs. What's the total asset? So here we've got the 152, and actually we can see that the total liabilities are higher. The total liabilities are 170, 211. So that's kind of increased a lot on the previous year as well. And because the liabilities are greater than the assets, what that means in terms of the equity is that we're actually, or the company is actually in negative equity. So you can see here they've got an actual shareholders deficit of $18 billion, which is up from 8 the year before. So obviously this is a really big kind of warning sign as well for Boeing. So you can see now the overall, we look at the total assets, the 152, total liabilities, the 170. So we're looking at the difference between the 152 and the 170, which is obviously negative $18 billion. So that kind of shows you two kind of very different examples from one company who's been thriving and another who's been really struggling recently. And this information presents itself on the balance sheet for us to be able to see as well. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel as well if you haven't already. It really helps me out with trying to grow the channel to more people as well. And leave any comments you've got as well, because I'm also always interested to know what you think about the content. Is there other things you would have added into this? Because I know this video is kind of just a starting point for the balance sheet. You can go into a lot more detail as well, but I just wanted to give like a bit of a quick guide to this. So keep an eye out for the next video, which is the cash flow statement, and that's part of my financial statements playlist as well, which you'll be able to find in the description. So thanks for watching, and I'll see you in the next video. Cheers.